Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Kate, welcome to this episode of the Australian Finance Podcast.
Wonderful to be back, Owen.
Yes, it is, because we are joined by Pete Wargent. G'day, mate. How you doing?
I'm slightly out of breath because I've just pegged it halfway along Flinders Lane to be here. But yes, great to be back on the show.
Yeah, longer than you thought, Flinders Lane.
Yeah, well, when you sort of see the name Flinders Lane, you've got in your mind maybe a short Melbourne laneway, but as it turns out, it's about 3 miles long. So bit of an effort to get here, but good to be here.
Yeah, it's great, mate. And this is actually the first time that you have recorded in our studio here in Melbourne, because you're in town. You're from Noosa, right?
Yeah, well, not originally, as you can hear from my accent, but yes, I live in Noosa Springs, and down in Melbourne for a few weeks though, so just enjoying this beautiful grey vista out the window.
Yeah, well, you've given up the sun for a bit of cloud. Welcome to Melbourne, mate. So people who listen to our Investors podcast, which is the yellow one that's in their podcast feeds, and it tends to focus on slightly more advanced topics like property investing, share investing, so on and so forth, they'd be familiar with you and they would have heard your voice multiple times, because I had you on the show maybe 3 months ago and we talked about basically what's happening. What's the data and property telling us? People would be familiar with you there, but here, first foray on the Australian Finance Podcast. Can you tell us a bit about yourself? Like, what do you do? The books you've written, pretty good back catalogue, mate.
Yeah, well, originally English, as you can hear. Came to Australia as a backpacker originally to play cricket. I actually became an Australian resident and then citizen through the points test, the skills test as it was back then as a chartered accountant. Big interest in investing, stocks and property. I wrote my first book on personal finance around 2011. So I've been sort of relatively well known in the space, mainly for property these days. I guess like a lot of property investors, you tend to end up a bit top heavy in that asset class because of the leverage, right? That's what I do. I've run a buyer's agency for about 11 years or so in Australia and England, in London. With these days we have a national buyer's agency platform called Buyers, and we buy in every state and every territory. So
you help buyers right around Australia connect with people, with the experts, but also then find the property that's right for them.
Yeah, I think a lot of buyers agencies tend to just buy in their own patch. And the concept behind the business, and we set it up a couple of years ago, is to have a central office where you get independent advice, whether you should buy in Adelaide, or if you're an investor, should you go interstate, or should you buy your home first? So we spend a lot of time with people working on the strategy first before then sort of recommending whether or not they invest in property. I think sometimes people get it a bit, I was going to say arse about tit. I'm trying to think of a better phrase. The wrong way around. I think sometimes people, they start with just, I can afford to buy property, so I should buy something because that's what everyone else is doing. But we tend to try and think more strategically because these days everyone has a limit to how much borrowing capacity they can take on. And therefore, if you've got a limited amount of borrowing capacity, you want to make the maximum or the best use of it.
If someone's unfamiliar with the job of a buyer's agent and what they do, are you able to explain a bit how you help home buyers?
So in Melbourne, they're often called buyers advocates, confusingly. The rest of the country tends to say buyer's agent. But it's essentially a real estate agent who works exclusively on behalf of the buyer. So now you guys have been first home buyers. You know how intimidating it is the first time you buy a property. There's lots of stuff you don't know. A buyer's agent will step you through that whole process and just help you to avoid some of the pitfalls. Because they're in the market every day, they have access to off-market properties, for example, but they can also help you with the negotiation, so negotiating the best price and terms. So if a buyer's agent's doing their job well, It should be really at least a cost neutral service, but also they can help you to avoid some of the pitfalls involved of buying property. Think back to when I bought my first place. I really, as a finance professional, you feel like you should know these things, but I had no idea what I was doing. Didn't get a strata report. I bought a place in Bondi, like a lot of POMs, and overpaid and made loads of mistakes that if I'd had a buyer's agent just to tap me on the shoulder and step me through the process, could have easily saved on the purchase price. Probably might have bought somewhere with a cheaper strata fee as well. So,
and the thing is, the first one's really important. I know you don't just work exclusively with first home buyers, but that's important because that is a massive asset for people. And buying the right home the first time can be, the difference between greatness and a real headache.
Increasingly so. I think with higher purchase prices these days, especially in the big cities like Sydney, Melbourne, Brisbane, making the first right step is so important. We often say these days, even a first home buyer really needs to think like an investor because it may not be first and foremost an investment, but it's probably one of the biggest purchases you make in your life. And certainly being a Brit, we've had the boom bust economy over the decades. You see people who buy at the peak, make big mistakes. It can set them back years and years, in terms of their financial progression, because if they're in negative equity or underwater, very hard to move forward from that. So avoiding those mistakes, it's critical really, because as you say, if you buy well, build some equity, that can be something that you can then leverage or build on down the track.
Yeah, for sure. Before we get your property update for 2022, can I just ask another question? Because we cover this on the Investors Podcast, just to set the scene. We talked to you about property. I talked to you about property a lot. But a lot of people, I don't want to pigeonhole you like that, because a lot of people who've read your books will know that you were basically a pioneer before fire was fire. You went about becoming financially independent, and you achieved that really early. Can you just fill us in on that, briefly? How long did it take you, and how old were you when you achieved that?
Yeah, I think if you read a lot of this sort of financial independence, retire early blogs these days, they're very focused on buying index funds, income focused. Our journey was a bit different because my wife and I were both directors at one of the big four accounting firms, higher income earners. Both of us, I wouldn't say we sucked at it, but we weren't particularly, high performers in the professional sphere. So our journey, and bearing in mind borrowing capacities were a bit different back in those days. We went very hard into property. That was our journey, mainly in London. Bought a few properties around Sydney during the financial crisis when things had there was a bit of panic around. So look, it was mainly a property-based journey for us. I was mainly interested in stocks originally. It was it's actually my wife Heather who got me into real estate, because when we first met, she was doing so much better than me, and it was largely because she'd bought a house when she was 21 in a place called Cambridge in England. And there was that sort of brought me around to the idea that if you buy well in property, the leverage can help you. So yeah, I quit the full-time gig at 33. Yeah, we had a portfolio of properties mainly in London and Sydney. But there's different ways to go about it. A lot of the fire blogs these days are more focused on dividend income, which Australia is obviously very good for.
Yeah. Kate, you're recently a property owner.
Yeah.
Yeah.
It's very different now because all the property episodes we've done, I was mentioning before, over the past 4 or 5 years, I haven't owned a property, and I haven't really been that interested in property because I've just been investing in shares and ETFs. But now it's a little bit different. This is the first episode we're doing about property where I've actually got some skin in the game.
I think it's actually a really interesting point you touch on there, and that is there's definitely a thing when it comes to the property versus shares debate. You're just drawn naturally, I think, a lot of people in one direction or the other. I remember reading Owen stuff from Motley Fool and stuff years and years back, and you could just say, he's a stocks guy, and it's not necessarily that one's right and one's better or whatever. It's, some people are just more drawn in one direction than another. Now, in my journey, I started out mainly interested in stocks because I was a chartered accountant. I used to write annual reports for the listed companies. So I used to think that, well, this must be my edge, right? Because I understand the accounting standards. But I've actually found from a behavioural advantage perspective, I've found property easier because we've got properties we've owned for more than 25 years, right?
Wow.
You know, the average stock period, the stock holding period, you would know better than me, but it's probably 5 months or something these days. And so every year when I do my tax returns and you see, these properties that we've had 15, 16, 17 years, that's really where I found the behavioral advantage comes in. It's not necessarily, that the returns are better from one asset class or another. It's about finding what works for you and what you have a preference for.
It's a huge advantage. And I've got to admit, I think everyone goes on a journey, right? I own a property. And I think we are presented with false choices a lot. We talk about this quite a bit. You don't have to make a choice. You should own both, right?
You're going to mention the why not both meme, aren't you?
Yeah, that's it. Yeah. No, but it's true, right? Like we do become, I don't know, parochial. We tend to think this is I'm going to put my stake over here. This is where I am. That's where you are. We can be mortal enemies. And at the end of the day, it doesn't matter. Money's very individual.
Every finance book ever written is this is how I made my, my pile, and you should do the same. Whether it's business or property or shares. The reality is there's all different personality types. And also, as you mentioned, as your life stages change as well, your preferences change. You've got some people have much less tolerance for risk, for example. In my case, we had a couple of kids. Suddenly it's changed my whole perspective. Now I don't have to be the best. I just need to not do something stupid. When you're younger, of course, young alpha male or, not so much me, but a lot of people, they have to, they have to try and be the best at everything. Whereas, as you go through life, your priorities change and therefore, your asset allocation might change. I mean, I think financial advisors always knew this, the tilt in the portfolio as you get towards retirement. But with asset classes, it's a bit different with property because of the leverage involved. The risks are actually different. It's, as you said, exactly the right phrase. It's a journey for everybody, and you've just got to find what works for you.
Pete, a lot of people are scared about property right now. Interest rates have gone up. Mortgages are more expensive. 2022 is not like 2021, it seems. How are you thinking about that?
Well, I guess one of the advantages of being around for a few cycles is that you've seen this a few times before. I think it will never change. When property prices are falling, nobody wants to buy. And then, of course, the market will turn. There'll be a few headlines about rising auction clearance rates. And then everybody comes back into the market. Everyone out together, everyone in together. I don't think that will ever change. I think in terms of, for sure, rising interest rates, it's the one thing that has really killed confidence at the moment. If you look at all the other fundamentals, population growth is coming back, lowest unemployment rates in 50 years, wages finally actually going up. Most of the fundamentals actually look strong for housing and housing demand. The one thing everyone's worried about is, a lot of people haven't seen interest rates going up. Now we've gone, at the time of recording, yesterday we went first interest rate hike. There wasn't 50 basis points. We had 4 in a row. There were 50. So we're getting closer to the top of the cycle. And actually, if you look at futures markets and what markets are predicting, the terminal cash rate, so that's how high it's expected to go in this cycle, is actually a couple of interest rate hikes lower than a couple of days ago. So I think people will start to get some comfort that interest rates aren't just going to keep going up forever. But for sure, if you're a first home buyer today, you do need to factor in that we'll probably get a couple more hikes, maybe 3 or 4.
Yeah, it's been interesting because now I have purchased a property. I'm getting those emails from my lender on a monthly basis saying, your home loan repayments are increasing next month, which is quite interesting that you don't necessarily know what the payment's going to be next month.
Yes, it's the worst day of the month for email spam is when the Reserve Bank policy decision comes out. I think I tweeted yesterday, I'm going to go to the gym before I get these 4,000 emails about the interest rate decision. And that's how monetary policy works, though. And it does work with a lag because it takes a bit of time, firstly, for banks to update their mortgage rate. Secondly, for people to actually realise how much the mortgage payment has gone up. And then thirdly, it actually takes a bit of time for people to see that impact. So that's why an interest rate hike today, the full impact might not be seen for 12 or 18 months. So, it's a significant increase when you take a cash rate from the 0 lower bound up to 2.6. That's the fastest tightening we've seen since 1994. So, pretty much anyone under our age group and below hasn't seen that before, and it can be scary.
A lot of people are wondering, Pete, like all of this change so quickly. Should we alter plans that we have with property? Should we not do the things that we were planning to do, or has it changed fundamentally? You said you've been around the block a few times with this. Is this a fundamental change with property? People are predicting some pretty scary stuff.
I think you'd be surprised. I think it's interesting that a lot of the indexes you see, they do lag a little bit. They're often they're sort of not, it takes a while for properties to actually sell and then settle and then be recorded. I think in a lot of cases we have seen prices down 10 or 15%. If you look in, say, Sydney Northern Beaches or some of the premium suburbs in Sydney's eastern suburbs, prices might well be off 15% from the highs. But I suppose that does come in the context of a 50 or 60% boom just in a couple of years prior. So certainly the same in Noosa, right? Prices have come off the highs a little bit. I think the thing I've always felt about real estate, because of the transaction costs involved, it works much better as a 20 or 30 year investment. As a home buyer, it's different because it has to fit around your life plans, and you might look to trade up. But if you're going to buy as an investor, you really need to be taking a 10 or 20 year view. So in that context, you'll get interest rates going up and down through that period. You'll probably have a recession. You've got to expect those things because that is what happens over time. So no, I don't think things have changed too much. I think the big thing for Australia, and you can just start to see it now in Melbourne, over the next 2 or 3 years, there'll be 1 million extra people in the country. Lost 600,000 temporary visa holders kind of disappeared through the pandemic. They're starting to come back, mainly international students so far, but eventually we'll get more tourists. We'll get backpackers if the flight costs ever come back down. And also the permanent migration cap has been lifted to the highest level in Australia's history. So it won't be long before we see the population go from 26 to 27 million. It's a huge amount of demand for housing. So yes, interest rates are up, but they're actually up because the economy is overheated.
And I think that's a worthwhile reminder, right? And I think the way you started to answer that question is key for me. You said, because of the transaction costs, look 10 or 20 years into the future. A lot of people get hung up on this, like the things they see on TV where they're like, renovators delight, flip it, make money from property. That's how you do it. When you're a prime example, and we've spoken about this in the past, your wife, she's held since day one.
Yeah, we've never sold a property. Yeah, I often fantasize about it because
you're like, look at that bank account.
You're going to sell some properties and move to Koh Samui or something. But I think, as we talked about on a previous podcast, my wife came from a farming family, and her dad taught her you buy land and never sell it. So she's absolutely adamant we're not selling. And I think over time that does tend to work. I think it's not to say it's impossible to make money from buying, renovating or developing property, but in the current environment it is very difficult because materials costs are up. The availability of traders is well down if you can find one. So it's possible to do cosmetic renovations and make money, but by the time you've paid the stamp duty, capital gains tax, there's probably easier ways to make a quid at the moment, I would say.
And given that we like quick wins, and the idea of going into a property for 20 or 30 years seems pretty insane to me. Like, how do you reframe it so you go in with the right intentions when you are buying an investment property? Yeah,
the sort of the visual that I tend to think of, because you're right, we often get people, even clients, they buy a property and then 3 months later, what's it worth today?
What's the next thing?
What
are we doing now?
Well, it's a different game, very slow in that sense. And some people actually find it boring or too slow for them, because for better or worse, a listed stock or company, you'll get a daily update and there's always more annual reports or releases to read. I tend to visualize real estate investing is like a snowball. You're just building a snowball for the future. I tend to, if I buy a property today or some farmland or whatever, tend to try and think of it as something for the kids and then not really worry about what's happening day to day. I mean, it's pretty much what Warren Buffett would say about buying a stock. If the fundamentals and the earnings are increasing, don't worry about the price so much. But Of course, in the modern era, that's not a popular viewpoint, but because everyone wants a quick win, hence the popularity of cryptocurrencies and Web3 investments and all the rest of it. People want money today, but it's actually more about building the compounding machine.
Yeah, there's a Netflix doco now on GameStop. So it's hit it's in the zeitgeist there. And because you said Warren Buffett, I think Kate has to do a shot after this.
So there's a guy, Jake Beasley, who I know used to say you're only allowed 20 Warren Buffett quotes, and if you use up your punch card, you get sidelined from social media. And I think I've just committed the cardinal sin. But shout out to Jake,
mate. So Kate went through the journey last year, this year, buying a first home. I did it a few years ago. A lot of people listening to this, Monique, just over here, she did it a little while ago. A lot of our audience are going through that process, or even they're thinking upgrading, right? And you say, think about it like you're giving it to your kids, or think about it like we're talking about lifestyle assets here, so it's a little bit different. You do trade up and whatever, but obviously that puts a lot of it puts a lot of perceived pressure on people to buy right. So how do you what kind of wisdom can you give us, given this is your profession and what you do every day? If listeners could take a few things away from this conversation, if they're in the buying process, what can they think about?
Yeah, I think the first thing you already touched on there is to have a strategy. Why are you doing it? Because although it's not always popular to say, sometimes renting is actually better. You can rent, you've got flexibility to move around, invest your money elsewhere. If you decide to become a home buyer, ideally you probably want to be in that property for a few years to justify the transaction cost involved. I think, and I'll probably make a few enemies by saying this, but generally, it's a very general rule. Probably get a few developers on my case now. But if you buy brand new property, that statistically works out worse for people, because you tend to pay a premium to buy brand new. It's tempting because everything's shiny and new and everything works and it looks the goods. But actually, if you buy off the plan or buy brand new, you're more likely to make a loss on resale. That's not just an opinion, statistically. Because like buying a new car, it's when you come to sell in a few years' time, it's not new anymore.
And we see that with apartments too, right?
So, a lot, yes. And especially in Melbourne, Brisbane, where people buy brand new off the plan, so it's a bit of a shiny toy syndrome as well. But when you sell to the second user, it's no longer a new property. So generally buying established has less risk involved. And I think that, the big thing is really the due diligence. And generally, if you look at it in terms of types of property, well, I guess there's an old adage in property that sort of land appreciates and buildings depreciate, which, if you take that at face value, you probably want to buy properties with a reasonably high land to asset ratio. If you buy out, take an extreme example, buying out in the boondocks, you're just buying bricks and mortar. There's no land value. So you're probably not going to see an appreciation on that type of an asset. But if you're buying in metro areas where the land component is higher, then that generally tends to fare better. Now, if you apply that to a unit or apartment, it probably means if you're buying in a block of 350 units, there's not much land value. But if you're buying in a more boutique block or a townhouse, then there is a bit more land component. But a lot of it comes down to market research, really. If you're going to buy in a strata block, I think some of the pitfalls, buying into places with very high strata fees, that can become a pain in the backside very quickly, and you'll find reselling harder. And just do your market research. If you're going to buy a unit, you want to know what's going on in the strata scheme, because they're not run by professionals very often. They're run by lay people. So you don't want to pick up a special levy, noise issues, tenant issues. There's a lot of stuff you could fall into. And that's what I was talking about at the start when I bought my first property. I didn't know any of this stuff. Looks like a nice place, I'll buy it. But there's there's a bit more market research and due diligence to be done, I guess. And
you can look at, because Kate's sorry, I didn't mean to cut you off here, Kate, but Kate's had experience with this too. But you can look at the strata or body corp.
The body corporate minutes, yeah. So you can pay for a professional report to be done. Cost a couple of $100. Somebody will read all the body corporate minutes, and if there is a significant issue, in terms of the sinking fund, or if there've been noise complaints, or there's damage to the block, it will be in the minutes somewhere. It's very easy to buy into a place and then find out in a year or two, well, there's a special levy to cover an issue that was actually known about before. It happens. I've fallen into it myself as a young investor, and I guess to some degree, it's through making those mistakes is how you learn, I suppose.
Yeah, I think it's really interesting because until you become interested in the property buying journey, you know there's fees and costs associated with it that are a lot more than a brokerage fee for an ETF. But you don't really realize the scope of all those different fees and costs until you actually start becoming more serious about your property buying journey and all of the different things. I didn't realize conceptually how much stamp duty was. Like, it was just overwhelming, the number of fees and legal fees and council and strata and like the different people you need to have a look at the property. And look
building
at the
and pest inspection. If you're an investor, you might get a depreciation report. There's plenty of potential costs. You just touched on a really important point there, stamp duty. So in New South Wales, we've been talking about this for how long? A long time. First home buyers from January next year will be able to opt whether to pay stamp duty or not in favour of an annual land tax. So I think talking about first home buyer tips, for if you're in New South Wales and your purchase price is under 1.5 million and you're a first home buyer, well, you need to start having a think about the implications of this prospective change, because there'll probably be a bit of a rush on first home buyer properties as soon as the change comes in. I think if people don't have the deposit, they'll probably be tapping the bank of mum and dad saying, look, there's no stamp duty now. Can I get on the ladder? So I think that's one of the things to be across if you're a first home buyer is what are the rules in your state or territory, and make sure if there's a first home buyer guarantee available or whatever it may be, just across those rules. And that's where a professional advisor comes in, right? Because they do that stuff every day.
Pete, do you think that eventually that change will just mean that prices go higher because everyone opts to not pay the stamp duty?
I think, yes, from the bottom of the market, yes. I mean, if you look at all the first home buyer sort of boosts and levies and so on, the first homeowners grants in 2008 or 9, whenever they came in, they tend to just get whacked onto the sales price. So it gets priced in pretty quickly. That's usually what's happened when you actually give a boost or a handout or a grant or whatever. I think the general idea is that over time we'll transition away from stamp duty, which is very lumpy and pro-cyclical tax, towards an annual land tax, which is obviously much smoother revenue for the government. I guess there's arguments for and against land tax. It's an annoying annual fee for people, and I guess the challenge with it is when you've got people who've already paid their stamp duty, they're saying, well, I'm not paying a land tax, so that's why it can only easily be phased in over time, which is what they're trying to do in New South Wales.
So I just got one more follow up on this point, because a mate and I had a disagreement about this recently. Is if you elect to not pay the stamp duty up front, you just take it like a yearly land tax, does that stay with the property?
Yes, it's based on the actual asset or the property in case. In New South Wales anyway. It may be different when other states come to tackle it.
So then if you're the next buyer, you don't have a choice.
That's exactly it. Yeah, and that's how we phased in over time, because presumably most first-time buyers are going to say, why would I pay stamp duty up front? It's the old bird in the hand versus two in the bush idiom, or whatever the phrase is. We'll edit that in later. But it's but that's right. But it stays with the property, not the buyer. So the next buyer of that property will not have a choice. Yeah,
and then that makes it so I'm the type of person that if I could pay for it up front, get rid of it, because then in 10 or 20 years, like, you've got that benefit of not having that extra tax that someone just decided because they wanted to get on the property ladder 20 years ago, you're still paying. And that, for me, is like keeping the holding costs low, right? I liken it to almost like you're making a choice where if you use ETF or index funds, it's like, do I pay the brokerage up front, or I'm just going to pay the same amount every year for forever? It's like an account fee. I'd rather pay it up front.
Yeah, there's been an equivalent situation with lenders' mortgage insurance over the years, right? So you whisper it quietly. pre-2007, you could buy with no deposit at all. In fact, in England, you could get 110% mortgages and whatever. But there was, what could possibly go wrong? Actually, over the past dozen years or so, you've sometimes had that. If you've got maybe a 5% deposit, you just say, well, instead of saving up to get to 10 or 12, I just buy now, suck up some lenders' mortgage insurance, and I get on the ladder sooner. I think in a rising market, people generally do that. When the market's cooling, then you might be a bit more reticent and sit on the sidelines, which is actually exactly what's happening this year. People have got mortgage pre-approval, but they're like, but the market's falling, so why would I rush in? I think you'll find most first time, it's like the old marshmallow test, right? Most people will just take the marshmallow now and not pay the stamp duty, I guess.
Yeah, for sure. But sorry, it's
interesting for Owen.
Yeah, so say like you as an established property investor and owner, would you then, when you're buying in 2 years' time, say, you're going to take that into account because you might be like, well, I can afford the stamp duty and I'm going to hold it for 20 years. Do you understand where I'm going with this? Or?
Yeah, and this is why you'll never get a job in politics because they never think this far ahead. This was the whole. This is a rerun of the negative gearing debate in 2019. Bill Shorten and Chris Bowen went in with this policy. You can still negatively gear a new property, not an established one. No impact on the market, and it's like, okay, that's this is what they call like type 1 thinking and Daniel Kahneman. System 1. But then it's like, but what happens when the next person comes to buy this property and they can't negatively gear it? The resale market falls away. So it does have an impact. So, but we just went through, let's not bore people too much with tax talk, but we just went through this with the Queensland land tax, right? They came up with a plan where they would tax, so somebody has a rental unit on the Gold Coast or Gladstone, but the Queensland government is going to tax people on their holdings nationwide. And people will say, well, hang on, I've got this 200 grand unit. I'm getting 10 grand extra land tax because I've got a place in Brunswick or whatever. But they were thinking very much about the revenue. They weren't thinking about the unintended consequences and the system 2 type thinking, which is, what's this going to do to the rental market?
Yeah.
This is actually some of the challenge with the change to stamp duty. It's like, it's not really about the first home buyer in January that's the issue. It's like, what happens down the track when we've got properties with different tax regimes? Yeah. So it's an administrative nightmare as an accountant. I'm sitting there thinking, well, anyway, but it will create some of that down the track.
I feel like we love complicating our tax systems in Australia. Don't we have some of the most complicated tax rules in the world?
Well, because we've got 6 states and 2 territories. This is one of the reasons, actually, interestingly, why in the United Kingdom, it's mum and dad landlords is not really a big thing. You get professional landlords with 300 properties. In Australia, we tend to have a lot of people with 1 or maybe 2 because negative gearing. But if you try and grow a portfolio, then different taxes, got their land taxes, and it becomes, if not impossible, it becomes much harder or less attractive. So we tend not to have many professional landlords, and we don't have big institutions because the land tax kills you. So hence why what we have is a lot of people with a home, 1 rental property, their money in super, because that way you're not getting killed by the land tax.
Interesting. All right, Pete, I have 2 big questions for you that we get asked a lot. Whether it's about investing, whether it's about property, whether it's about anything to do with money. Is it too late to buy and is it too late to sell? So I don't know which one you want to tackle first.
Well, this is the spring selling season that we're just going into. So if you're going to sell a property, typically now is about the time. There's enough of a lead up between now and Christmas to have a full sales or auction campaign. So I guess no, depending on the market, obviously, but it's not too late to sell. I think in terms of buying, I mean, it really goes back to that time horizon. I think the market's certainly down from the highs. Might have a bit of a way to fall from here, but I guess how long are you thinking of owning the property for? If you're thinking a time horizon of years, then it's probably not a bad time to get in. You've just got to factor in that mortgage rates will go up a bit from here. So does that answer your question or questions?
Well, I'm not planning to do either right now, but I know a lot of people have these questions in mind because they feel like they've missed the boat on either way.
Yeah, I think, usually a buyer. I mean, it's a lot easier to buy now than it would have been in October last year. You'd have had 100 people at the open home and 50 people bidding at the auction. But there's a strange social proof in that people think, well, everyone else is here bidding. It must be a good idea,
Yeah.
Whereas when you're the only person turning up to bid at an auction, you can negotiate well, you can buy quality assets at a reasonable price. But people feel very uncomfortable with that because, not least because, property gets a lot of media headlines these days. Even this morning, property prices to fall 20%. So well, they might have already come off 10. So. Yeah,
they all tend to go back to the same 2 or 3 experts.
Yeah, who predicted a crash 2 years ago and 5 years ago. Yeah, there is a bit of that. I think it's difficult to go against the grain, certainly. But as you know, it's exactly the same in the stock market. That is generally when you get the best results.
Yeah. I guess given it's such a big purchase and for first home buyers, it's a really scary experience. So we're looking for a lot of external validation that it is the right time to buy.
Completely. Yeah, absolutely.
I feel like if I would be much happier buying today than when I did a few years ago. Like we've made, like the property value's gone up, but I would be very happy if I was a first home buyer today. Yes, interest rates have gone up, but if you're a young professional, your income's typically pretty good and your earnings potential's pretty good. So I feel like, that's where I'm an optimist by trade as well.
There's not many forced sellers around at the moment. Everyone who wants or needs a job has got one within reason. There's always going to be some frictional unemployment, but it's the lowest in 54 years or something. Incomes are generally on the way up now. Rents have been going up in some cases at 20% per annum. There's not many forced sellers around. Yes, mortgage rates are going up. Now, if they went up to, if the cash rate went to 4%, we'd see some forced selling then. But anyway, I mean, touch wood, we're not going to get there. Looking at the latest trajectory and the latest futures market.
Yeah, well, hopefully for us homeowners, come on, you good thing.
There are a lot of vested interests in real estate and stocks, but you're right though. Generally, people who are not owners are always hoping for the crash, and people who own, tend to become much more mellow about their commentary. that is the nature of the beast.
Mate. So if we can give you a quick fire question, is the property market about to crash?
No.
Okay.
In one word answer, no. I think in fact, if anything, the interest rate hikes are having a bit less of an impact now because people can see we're getting closer to the top. I think the first couple actually were a bit scary for people who haven't seen this before. What's it going to do? But I think as well, people read sort of doom and gloom media for too long, they just get bored of it. Most down cycles, they don't go for too long, 12, 18 months. So I think we've probably seen the worst of it.
All right, Pete, what is your number one tip for first home buyers in 2022 and 2023?
I think the main thing is just strategy. Try and start with the end in mind. Why are you buying? Is it because of an external validation, or what? Start with the why. Is that a Simon Sinek thing? Probably. Try and start with the strategy, because as I say, even first home buyers these days, you'll be well served to think like an investor. Even if it is a place you're going to buy and live in, try and think, with a financial mindset as well. And then when it comes to actually choosing the property, it's all about the due diligence and market research. If you're a bit stuck on places to buy, we've actually got some pretty useful tools on our website, actually, if I can give those a plug. If you go to buyersbuyers.com.au and just look at our property reports, we've got a tool there called the Where to Buy report, where if you key in your budget and some of your parameters, it will spit out some recommended suburbs, but also the statistical validation for why those suburbs are recommended. It's quite a powerful algorithm. It will give you at least some starting points in terms of thinking about where and what you should buy.
Is that free, that report?
It is currently, yes.
Currently?
Yeah.
Get in quick.
Get in quick before...
You'll leave it up for a few more weeks after this episode goes live?
That's right.
Yeah.
Or you can always shoot me an email if you're a listener of the Rask podcast.
Yeah, cool. Pete, I'm glad you gave a plug for Buyers. I know it's a startup that you've been working on. There's a few of you working on it now, and it's a really good platform. I think the idea and the concept behind connecting buyers with experts is just super important, because even your answer there to that last question, like the first home buyers tips, is like start thinking like an investor because it's a big purchase. And I see a lot of people, they just concede. They're like, yeah, I mean, I could, but I'm just going to go buy this apartment. And sure, the apartment might be right for you, but for some people that think, well, maybe I could have done this or maybe I could have done that, having that second opinion is so important. So Pete's really prolific on Twitter. I'll put a link in the show notes.
Too prolific. Yeah, I need to try and get off that.
Yeah, he's a good follow. Like, he tweets every day. You got the blog, the website. So we'll put all the links in the show notes, mate. We really appreciate you taking some time out while you're here in Melbourne and coming in to meet Kate and I.
Pleasure. I've been promised that the sun's going to come out for the weekend. I'll be down on St Kilda Beach with a shirt off, but it needs to
Head
get above.
down. Bring your binoculars.
Needs to get above 16 degrees first. But no, it's been great to get down there.
Yeah, mate. We really appreciate it. And Kate, as always, thanks for joining me.
Thanks for joining us.
Thanks, guys.